The first investment property is usually one of the hardest for most people. Some people are lucky enough to be able to keep the existing home as an investment and then buy a new owner-occupied. Now, with some of the new lending rules, this is actually getting harder and harder. So most people that are buying investment property nowadays are likely going to be able to buy something that is lower value than the current owner-occupied, meaning they have a lot less choice. What's going on, everybody? It's Blandon here for Mortgage HQ. In this video, I'm going to share 3 tips with you on what not to buy for your first investment property. Of course, this video is not for everybody. If you want to grow your property portfolio faster and avoid costly mistakes, you need to make sure that your strategy lower the risk of getting stuck. Now keep in mind, this is for new investors, so there are exceptions if you are slightly more experienced. For example, first one is if you're willing to invest a ton of time to learn. And when I say a ton, I mean a ton. Because personally, when I first started investing, it probably took my 3rd property or 4 years before I can say confidently I know what I was doing. Secondly, you might have industry insider knowledge, meaning you know the house better than anyone else and you know how to fix something that others don't. And thirdly, of course, there is always the right price for any property. If the deal is solid and is well under market value, it might be something that you want to consider. With that said, let's get into it. The first type of property that you want to avoid are plaster homes. Now, they can be tempting because when you see the listing, they're usually 10% to 20% lower than their counterparts. Something that has a better cladding like weatherboard or brick. You got to be especially careful with properties that are built in the 2000s that are plaster. Since the properties built back then, the timber frames were not treated properly. And because plaster usually stay damp for longer periods, and if you have them too close together, the timber is not going to be as durable and therefore causing what we call leaky homes. Now, the modern cladding relies on more breathable systems to avoid this matter. There are also plaster homes with what we call cavity. This is basically a gap between the timber and the plaster to reduce the chance of it being leaky significantly. There are also another category of plaster homes that don't fit in this category. They're usually older homes that are built in the 70s. They look like plaster, but they might be plaster on brick. This obviously will be worth more than your standard plaster home and is much more durable. But because the council recognized this as rough cast, which is the same name as the normal plaster homes, the CV is dragged down significantly by the other plaster homes in the market. Now, if you recognize this as an investor and the agent and other buyers don't, that is an opportunity for you to explore.
You smell that? What is that?
What?
What's that smell?
The cologne?
No.
Opportunity.
Second type of properties that you want to avoid are apartments. Traditionally, if you look at apartments, they have slower capital growth than your traditional house. This is due to the amount of land that you're getting on apartments. Now, this is not the only reason that you would avoid it. The yield on apartments can often be deceiving as well. You get higher than normal rent when compared to a house of the same price, but you also have a significantly higher body corp expense, which is usually much higher than your normal insurance. Now, the other downside with body corporate is that it lowers your lending. How so? When the bank calculates how much you can borrow, they will add the body corp expense as part of your personal expense. And usually this could be $300 to $600 a month, which would significantly lower your borrowing capacity. Whereas for residential investment properties, the insurance and rates are actually not added as part of your personal expense, which is slightly more advantageous when it comes to borrowing for investment properties. Now, please don't get me wrong, I do believe there are good investment strategies with apartments. I think there are a slightly higher complexity with apartments, and I do not suggest that for new investors. The third type of properties that you might want to avoid as a new investor are commercial properties. Now, despite the interest deductibility or the tax deductible expense that you can take advantage of in the new tax regime, I still don't recommend it as your first investment. The reason why: lending capacity requirements. Say if you want to buy a residential property, or a commercial property at around $1 million each, the lending that you can get on the commercial property is going to be significantly lower when compared to the residential property. That's because the bank is looking for a much higher cash flow on the commercial property. And if we dive deeper, this is because on how they look at the loan terms on these two types of properties. First one, commercial, is around 15 years on your servicing calculation, which means for the amount of loan that you're borrowing, you have to pay it back within 15 years. Whereas for a residential home loan on investments is 25 years. So the cash flow that is outgoing on the calculator is significantly higher, which will then lower your borrowing capacity. As an investor, you also want to look at your actual cash flow. 9 times out of 10, the repayments on the commercial property is principal and interest. You cannot negotiate interest only with majority of the banks. And if you add the commercial interest rate margin on there, usually 1% higher than residential loans, your cash flow commitment is going to be much higher, even though you're getting a slightly higher yield. Lease agreements can be a lot more complex when you compare it to your standard residential tenancy agreements. In saying that, there are situations that make commercial a significantly better investment. And from my observation after talking to hundreds of experienced investors, is that when you are in a very strong equity position, meaning you have several million perhaps just sitting there on some of your properties. Why is that? Commercial property tend to have a higher yield and lower outgoings when compared to your residential property. So your net cash flow position is usually way better on a commercial property, but the lending term sucks. So that means if you were to buy the two assets with cash, you're going to be much better off on the commercial property. So if you're trading some of your residential property for a commercial using cash, or you're using the equity on your residential property and you're borrowing money at residential rates on interest only, you have an unfair advantage on commercial properties because you're paying residential interest rate and getting a commercial return. So there you have it, folks. Those are my 3 recommendations on properties that you shouldn't buy as a new investor. Remember, if you have found value in this video, please smash the like button for the YouTube algorithm. It will help us tremendously. In summary, those properties are Plaster Homes, apartments, and commercial property. And if I was sum up one reason, they are more complex and they will grow your portfolio slightly slower unless you really know what you're doing. Are there other properties that you wouldn't buy as a new investor? I would love to hear from you. Leave a comment down below. Until next time, I'll see you guys in the next video.